Hello all and welcome to just another episode of Talking Finance with Henry Oster. Today we'll be talking about a very important topic on why microfinance fails. Why? That's a very, very big question for the outside community, for the microfinance community. You see an MFB spring up and everybody's happy. Then the next few years, you've heard that they've gone into liquidation. Why is this very reason? This is the reason why we are here today to look at some of these basic issues and things that have gotten them in such a mess. We're looking at 10 topics that are quite keen on knowing why these MFBs fail. Number one of this topic, we'll be looking at the risk management framework. What risk management have the MFB put in place to make sure that these loans, your portfolio is intact? It goes way more than just having a risk manager. The risk manager himself might need extra training to actually understand a microfinance bank. So you need to put policies, credit policies, operational policies, risk policies, recovery policies in place to make sure that your microfinance bank is on ground and stand by to make sure that whatever is being thrown at it, it stands. Risk management framework is very, very important. If you are a microfinance bank and you don't have a risk management in place, please, I recommend one. Get a risk manager, a risk management process in place to make sure that you protect your portfolio. This is very, very key for your problem. This is one of the biggest problems that is killing MFBs in Nigeria and all over the world. So risk management framework is key for you. And number two, we look at the weak corporate governance structure. Not everybody is supposed to work in a microfinance bank. That's one thing we don't know. Being a branch manager of a commercial bank does not mean you must know how to run a microfinance bank effectively. There are two different worlds. Microfinance bank is not theoretical, it is practical. Weak governance structures from the top management has also affected what happens to the to staff below, to the junior staffs. Weak governance structure in terms of decision making, governance structure in terms of policy implementation, weak corporate governance structure in terms of implementation from the top management. Whatever it is the junior staffs see you do, they want to do. So when your corporate governance structure is weak, it has effect all around the microfinance bank. It's just like a ripple effect. You drop a stone in the water and the ripple goes everywhere. If you are stealing, definitely your subordinates are bound to steal. If you are coming work too late, your subordinates are bound to come too late. If you are eating in front of customers, when you are supposed to be attending to them, it's bound to replicate. So your corporate governance structure has to be in place where things will go smoothly. Set a standard. Let there be operational guideline for everything you do, and everything will work fine. It's not about you deciding at a particular point how it's being done. No. The governance structure on ground will do the work for you. Let's talk of undercapitalization. Now, a lot of people just want to do business. You just want to do microfinance. The first thing that comes to your head is, oh, if I invest 10,000 or 10 million, this is the interest I'm going to get. Microfinance is way more than that. The concept of microfinance is to touch the life of the active poor, not just to run all our profit and don't think of anything else. Once you understand this, you understand that you need to manage capital. Now, when you are undercapitalized, it causes problem for your microfinance bank. That's why majority of the time you push our staffs out to go and get deposit. It's just all about deposit. You can generate funds for microfinance bank in very clear terms, in other ways that are just very, very, that will work fine for your microfinance bank. So the bottom line, undercapitalization is a very big problem for your microfinance bank. So which means you need to look for funding partners, donor partners to try and give you funds that you will use to really expand your business. It's not just about just sitting down and wait for the money to come. It doesn't just always come like that. So you need to be fully and adequately capitalized to run your microfinance bank profitably. In number 4, let's look at misuse of funds. Wow, this is very, very key. We've seen microfinance banks fail in many cases because of misuse of funds. Majorly, probably you are trying to compete with commercial banks or compete with other microfinance bank. What? You want to buy cars for every staff, for every manager. Yes, this thing will come. They are important, but not just at your initial stage when you start your MAB. And at the same time, there are some things your funds are meant to do, not to go on frivolous holiday visits, over expensive training that are not necessary. If you are training, let the training be directly related to the job and not just one realization spot where you spend money. So misuse of fund is a key problem to why microfinance bank dies all over the world. Number 5, limited digital literacy. The world has gone past brick and mortar microfinance bank. If you are still operating the brick and mortar microfinance bank, then you need to make an adjustment. It costs you more when you try to still operate in the back ages. Financial literacy is key to you understanding how you're going to be navigating the microfinance world. We have very low cost third-party integrators that can help you optimize the performance of your MLB. So all you just need to do is look for these third-party integrators, get the necessary software, get the necessary applications, invest in technology as of now. One of the good things it will do to you is that if you are technology inclined now, you will reach a wider audience. When you reach wider audience, you have more customers. When you have more customers, you disburse more loans. When you disburse more loans, you have more revenue. That is why you are limited. Once you are limited, you are more limited when you are not technically inclined. Number 6, this is also a cancer you need to watch out for. The desire for high risk loans. We should maintain our single obligor limit by disbursing loans that are just in that category. But majority of the time, just because we have calculated how much we are going to make in a particular loan, we are tempted to do higher loans, which is way above our credit limit. Now, this is the advice. Stay within your limit. Don't be tempted to do high loan. Don't concentrate your loan in one bucket. Diversify your loan. This will really help you. Over concentration and high risk loans are killers of microfinance bank. You run a tier 1 microfinance bank of 200 capital base, and you want to give one person 20 million at a go. It is risky. Focus on your retail customer that you are supposed to attend to and just try and increase the member base. This will help you. Stop focusing on high risk loan. Okay, I think I need to shift back before I talk about this. Inadequate staff training and motivation. This is one big problem we have in the microfinance bank, and which is causing high staff turnover in microfinance bank. Now, this is the idea. If you don't train your staff well, they are not going to deliver. Poorly trained staff make a mess of your funds. If they are not well motivated, they are only out to work for you for some time so that they can go out there and seek for better jobs. So if you train them well and motivate them well, they can stay, they will stay. Motivation is not just about money. That's one big problem that we are seeing. It is not just about money. You can motivate your staff in so many ways. And once you have this taken care of them, you are taking care of staff, high staff turnover for your microfinance bank. A lot of customers out there believe that once a staff leaves your bank, they don't need to pay again. This notion is very wrong. So if you can make your staff stay, then you are making your funds come back. This is just a tip I want you to follow. Poor customer and relationship management in your microfinance bank. We've gone to some offices, you see some staff eating, you see some cursing. Internal and external, it is good for your business. Your customer don't want to do a business with you one time, but majority of the time you get a one-time customer because your customer service management is poor. You need to change this. This is a strategy to get more. Once you win over a customer, they go out there and do the marketing for you. But these days, you don't care because you feel you have much customer. If that customer is not connecting for me, you go to another person. By then, you lose lots of customers. So this is an advice I'm going to give you. Just don't believe your one-time customer should stay your one-time customer. Your one-time customer should be your marketing customer because it's going to go out there to do the job for you. In my number now, I'm going to be talking about this. Portfolio at risk. This is one of the biggest problems that you have in microfinance bank. The regulatory authority is not taking it easy with PAR. What is PAR? This is the active portfolio at risk, which excludes the interest. It takes cognizance of your portfolio that is outside, that is at risk. It has a portfolio agent that you really need to understand. A lot of microfinance banks don't understand it. Loan in PAR has threshold. It's either it's performing or it's pass and watch or is substandard, or is doubtful, or is lost. And these are categories from 1 to 30, 31, 60, 60 to 90, 90, 100. It's just like that. You just need to understand it. If you don't understand the part, you don't have any business working in a microfinance bank. But today, what we have, proliferation of people working in a microfinance bank, all because they are paying. It doesn't work that way. Please make do of all the stuff that needs to go through training so that they understand PAR. It's when they understand PAR, then they start taking the business as theirs. And number 10, we'll be looking at the regulatory compliance. How well is your microfinance bank complying to every instruction that has been given from the regulatory body? Majority of time, we skip sending return at the right time, which costs us some fine. But this shouldn't be. A lot of things we ignore. Regulatory policy is key to understanding the survival of your MFB. If you don't follow, that's when the hammer keeps knocking on the door of your microfinance bank. In that case, is where 183 got closed, 193 closed. What makes you think that's the end of microfinance closure? The advice is don't let your own microfinance bank be part of the ones that will be closed. This is an advice for you. These are the basic reasons why microfinance bank fails in Nigeria and all over the world, and I want to believe you can learn a thing or two from it. This is Talking Finance with Henry Oster on the Microfinance Arena platform. Kindly subscribe to this channel because I tell you, I'm going to be having more information on the microfinance. We'll be having some guests from time to time to discuss industry issues.